Have you ever wondered how stable your bank really is? You might think it's as solid as a rock, right? But let's take a step back and look at the year 2023, a time when the stability of the banking system was put to the test. It started like any other year, but beneath the surface a storm was brewing. It began with the Silicon Valley Bank, a name synonymous with innovation and financial security. And then, like a house of cards, it started to crumble. The bank, which had once stood tall, found itself in a crisis, setting off a chain of events that sent shockwaves through the financial world. But it didn't stop there. The crisis continued to unfold, revealing the fragility of our banking system. It was like peeling back the layers of an onion, each layer revealing a new set of challenges, a new set of risks. 3 major banks failed, marking this as the second largest bank failure in history. These were institutions that people had put their trust in, institutions that were supposed to be the bedrock of our financial system. And yet they were falling apart, one after the other, like dominoes toppling over. It was a wake-up call, a stark reminder of the unseen threat lurking in our banking system. And as the crisis unfolded, Wall Street strategists watched with growing concern. Goldman Sachs revised its recession odds for the year, giving the US a 35% chance of tipping into recession. It was a sobering prediction, one that reflected the increased uncertainty surrounding the effects of small bank stress. The bedrock of our financial system was trembling, and we were on the brink of a catastrophe. But as we'll see, even in the midst of chaos, there were those who saw opportunity, those who dared to navigate the stormy seas. But that's a story for another time. For now, let's reflect on what we've learned and remember that even the mightiest of institutions can falter. After all, the bigger they are, the harder they fall. When one domino falls, it's only a matter of time until the rest follow. This is a poignant metaphor for the banking crisis that unfolded, triggering an ominous ripple effect through the economy. The first domino to fall was Silicon Valley Bank, marking the onset of a banking crisis that spiraled into the second largest bank failure in history. As these dominoes toppled, the mood on Wall Street darkened and economic optimism faded into the shadows. Goldman Sachs, a titan of the finance world, revised its recession odds for the year, bumping it up to a 35% chance. This change was not a mere whim, but a direct response to the banking crisis. The tremors from the banking sector had shaken the very foundations of economic stability, and the aftershocks were felt far and wide. But the banking crisis wasn't the only harbinger of the impending economic doom. Other market signals were blaring loud and clear, yet they were largely ignored or dismissed. Crude prices, the lifeblood of many economies, began to plummet. This wasn't a mere fluctuation, but a free fall that signaled a deeper economic malaise. The falling prices of crude oil painted a grim picture of an economy that was rapidly losing steam. In the grand scheme of things, these falling dominoes were not isolated incidents. They were connected, each one triggering the next in an unrelenting chain of events. They were the symptoms of an economy on the brink of recession, a clear warning that was unfortunately overlooked. The signs were all there, but were we paying attention? As we navigate the aftermath of the banking crisis, we're left to reflect on the missed signs and ignored warnings. It's a stark reminder that when it comes to the economy, the dominoes are always lined up, and it only takes one to set off a chain reaction. What does the world's most successful investor think about this? In the midst of chaos and uncertainty, it's worth turning our attention to Warren Buffett, a voice of wisdom and experience in the financial world. Buffett, known for his shrewd and strategic investments, didn't mince words when he criticized the banking practices of the First Republic Bank. He disapproved of their risky maneuvers, contrasting them sharply with the prudent management of his own venture, Berkshire Hathaway. Buffett, who's known as the Oracle of Omaha, had some predictions for 2023. He foresaw lower earnings for most of Berkshire's businesses. However, he wasn't all doom and gloom. He predicted higher investment income from higher yields and better performance from the insurance segment. It seems that even in the midst of a crisis, Buffett finds a silver lining. But why? How could Berkshire expect to perform well under such circumstances? The answer lies in the method behind the madness. Buffett's Berkshire Hathaway is not just a single business, but a conglomerate of different ventures, each with its own strengths. This diversification strategy is a safety net, ensuring that even if one business performs poorly, others might do well. The insurance segment of Berkshire Hathaway, for instance, was predicted to perform exceptionally well. Insurance, as an industry, often thrives during times of uncertainty. People and businesses seek to protect themselves from potential losses, and insurance provides a means to do that. As a result, during a financial crisis, the insurance segment can act as a stabilizer for the entire conglomerate. However, it's important to remember that these are not guarantees, but educated predictions based on Buffett's years of experience and understanding of the market. The Oracle of Omaha has been right many times before, but he's also been wrong. His words are not prophecy, but they do provide us with valuable insight. Buffett saw the storm coming, but could we weather it? Only time will tell. But for now, we can take solace in the fact that even in the darkest of times, there are those who can navigate the stormy seas of finance with a steady hand and a clear vision. In the face of crisis, what can we do? That's the question that hovers around in the minds of many when the stakes are high and the path unclear. Warren Buffett, through his actions during the banking crisis, provides some answers. Buffett's approach to surviving in the storm of economic uncertainty is worth taking note of. Berkshire Hathaway, under his stewardship, demonstrated that weathering such a storm is possible with ample cash reserves, strong brands, and prudent management at the helm. Cash reserves provide the much-needed buffer to withstand immediate shocks and keep operations running. Strong brands retain customer loyalty and trust even when the market is shaky. And a prudent management ensures that decisions are made with long-term resilience in mind rather than short-term gains. But it's not just about survival. It's also about recognizing and seizing opportunities that arise in times of crisis. Buffett's Berkshire Hathaway took advantage of the downturn in asset prices, viewing the crisis not just as a challenge, but as an opportunity for value investing. This forward-thinking approach is a key lesson for firms navigating their way through similar situations. Moreover, Buffett expressed optimism about future value investing opportunities despite the disruptive technology that's reshaping the financial landscape. This is a reminder that even amidst rapid change and uncertainty, opportunities still exist for those willing to adapt and innovate. So, what's the survival strategy in a nutshell? Build a strong financial cushion, maintain robust and reputable brands, manage prudently, and keep an eye out for golden opportunities, even in the darkest of times. This approach requires courage, foresight, and a fair bit of tenacity. It's not about avoiding the storm, but learning how to dance in the rain. And who better to learn this dance from than the Oracle of Omaha himself? As Buffett shows us, there's always a way to survive, even in the harshest of storms. The storm has passed, but what have we learned? As we look back on the tumultuous period of the banking crisis, there are several lessons that have emerged from the rubble. Firstly, the aftermath underscored the absolute necessity of financial stability. The crisis was like a house of cards, with one small bank's stress leading to the second largest bank failure in history. It was a stark reminder that the entire financial system is interconnected. When one piece falls, it threatens to bring the whole structure down. Also, the crisis highlighted the risks of monetary tightening. As the Federal Reserve and other central banks tried to control inflation and promote growth, they inadvertently squeezed the life out of some smaller banks. It's a delicate balancing act, and one that needs constant attention and fine-tuning to prevent such a crisis from happening again. Moreover, the crisis exposed the need for improved banking practices. Warren Buffett, the Oracle of Omaha, criticized the practices of the failed First Republic Bank, contrasting it with the sound strategies employed by Berkshire Hathaway's insurance business. It's a clear indication that not all financial institutions are created equal, and those with prudent management and strong brands are more likely to weather the storm. Finally, the crisis underscored the importance of being prepared for economic downturns. Despite the challenges, Berkshire Hathaway remained resilient, capitalizing on low-priced opportunities. This resilience didn't come by chance. It was the result of ample cash reserves, a diversified business model, and a long-term focus. It's a lesson for all of us about the value of planning for the worst while hoping for the best. In the end, the banking crisis served as a wake-up call, a stark reminder of the fragility of our financial system and the need for constant vigilance and sound practices. The crisis was a wake-up call. It's up to us to heed its lessons or risk facing the storm again.